Hi, everyone, and welcome to the Bloomberg special Price of Power, where we take a look at the ongoing global power shortage. I'm Francine Lacqua here in London. Now, from Europe to Asia, supply restraints from the world's top producers could spell an energy crisis that could upend the global economic recovery. The price of natural gas and coal surges to multi-year highs. The post-pandemic rebound collides with colder months in the northern hemisphere. And avoiding a winter of discontent, governments warn of blackouts, and utilities and policymakers pray for mild temperatures. So European energy markets jump to record highs on signs that the shortage will only get worse as the winter season starts. In Britain, several energy suppliers have gone bust even during the summer months. Soaring wholesale prices made promises to customers undeliverable. Well, the UK government has made it clear it won't bail out failing utilities and has warned of higher prices for consumers.
You would expect normally that the price would revert to the mean. It's not something that we think is going to be sustainable. But of course, Mr. Jones, we have to prepare for longer term high prices.
Well, my next guest is the chief executive of UK supplier Octopus Energy, Greg Jackson. In September, it was announced that Octopus would take on more than 500,000 new customers from the collapsed supplier Alvera Energy. Now, to help with the burden, a clean energy investment fund run by the former U.S. Vice President Al Gore has bought a 13% stake in the company. This deal has pushed its valuation to £3.4 billion, more than British gas owner Centrica. Greg Jackson, welcome to Bloomberg and welcome to Surveillance. What are you seeing in terms of the supplier concern right now in the UK? How do you see this extremely volatile and concerning environment developing?
Good morning. Look, the reality is that the UK is no longer energy independent. Like so many countries, it's at the mercy of the global fossil fuel market. And really what we need to do is invest more in renewables so that the price of energy is something that's more in control based on kind of the local physics rather than that global market.
So, Greg, what does it mean actually, the $600 million investment? Does it enable you to take on more customers?
The $600 million investment is designed to let us carry on the massive work we're doing in research and development for a decarbonised energy system. Today, I'm here at the Octopus Energy Research Centre for Decarbonised Heating, where we are building the technologies to move away from gas and to make electric heating cheaper to buy, install and run than gas is.
Do you want to grab market share? Is this an opportunity for Octopus Energy?
I think it's incredibly important to understand the energy revolution is only going to work if citizens are taken on the journey. So what Octopus has done in the UK is, recruited more than 2.5 million customers based on the concept of cheaper, greener energy, that standing service powered by technology. We've just taken on, as you said in the captions, another nearly 600,000 through the problems experienced at other companies. And I think we now need to take this kind of citizen-led journey to decarbonisation global. So we will take on dramatically more customers directly, but also, we built a technology platform, Kraken, a sort of operating system for renewable energy, which is now licensed to some of the biggest energy companies around the world. And together, I think that's going to build a real platform for change.
Greg Jackson, who's accountable for this? Is it the government's fault that we are where we are? Is it private companies? Like, how can we be, what's happening today, September 27th, 2021?
Yeah. Look, there's a perfect storm in the world of energy at the moment. Post-pandemic, we've seen supply chain issues in so many markets, from silicon chips through to automobiles. Energy's been sort of exposed to the same issues. On top of that, we had long, cold winters in Europe and Asia. We've got depleted gas storage that hasn't been topped up around the world. And then, for example, in the UK, you've got a whole pile of our nuclear power plants offline. So this kind of perfect storm has pushed prices up. What it all does is point to the need for resilience through a more renewables-based system, not just in the UK, but globally. Not just for carbon, not just to tackle pollution, but actually to start moving to a much more resilient system to provide cheaper energy for people.
Greg, give me a sense of, what kind of renewables you're going to build. Are you going to build a renewable generation? And if so, where?
Yeah, so I think there's a huge opportunity for more wind, in particular in the UK. It's a very windy country. Moving towards floating wind is a really exciting opportunity. We've now got community support for onshore wind by bringing people cheaper electricity when they can see the blades turning on local wind turbines. We've got loads of solutions there. And then I think, it's exciting to look at what a globally decarbonised system looks like. The idea of, for example, solar farms in Africa feeding cheap green energy into Europe and helping both ends of that bargain is now looking like a realistic prospect.
Greg, do you think you're moving towards being an integrated utility?
That's a great question. Look, what we've got to do here is what happened with the internet. Governments kind of got the internet going, and then companies were able to take that infrastructure and really transform society through their own initiative, investment, and innovation. We now need to do that with the electricity system. And so, do we need integrated utilities? I don't know. But what we do need is the digital technology, the Uberization of energy, so that we can, in real time, be looking at the generation at every renewable point and then optimizing consumption to match, shifting the points when people charge electric cars, or feathering their heating systems to make the most of green electrons when they're abundant, and to reduce the need for them when the wind's not blowing.
Great. Thank you so much. Greg Jackson there, the Chief Executive of Octopus Energy, joining us this morning. Now, coming up, we have more on the price of power when we speak to Jeff Curry, Global Head of Commodities Research at Goldman Sachs, and Marco Alvera, the Chief Executive of SNAM. That conversation coming up shortly, and this is Bloomberg.
Reliability matters and affordability matters. And so if costs go up, consumers don't like that. And if reliability goes down, it creates real problems. And so it's one of the reasons that we have to be very thoughtful about changing the mix. And I think what we're seeing in Europe right now is wind and solar are great, but if the sun's not shining or the wind's not blowing, people still need electricity.
Chief Executive of the world's second largest oil supermajor, Chevron, speaking about the energy mix in Europe. Let's discuss this further with our next two guests. We're now joined by Jeff Curry. He's Global Head of Commodities Research at Goldman Sachs. He has been reported as the world's most followed energy guru. That's quite a title, Jeff. He's forecast oil to surge to $90 a barrel if this winter is colder than normal. Also joining us is Marco Alvera. He's the Chief Executive of one of Europe's biggest energy infrastructure companies, SNAM. He's also the author of The Hydrogen Revolution, a blueprint for the future of clean energy. So Jeff and Marco, welcome to a Bloomberg Price of Power special. Jeff, let me start off with you. First of all, we're trying to exactly understand what's going on. There's a supply crunch. Sure, gas here in the UK is almost impossible to get through, and partly it's, of course, because of Brexit and the lack of drivers. But is this a European/UK energy security problem, and how long can it continue?
Absolutely not. It is a global phenomena, and it's not unique to energy. It's across the entire old economy. Look at trucking in the U.S. These problems were with us long before COVID. We call it the revenge of the old economy. Poor returns saw capital redirected away from the old economy to the new economy. Let me ask you, what do you want to own, a FANG stock or a energy company? The returns in FANGs were much better, so all the capital got redirected to the new economy, choking off the capital that needed to grow the old economy. Then the COVID surge in demand just exposed all these problems. So it's not unique to Europe. It's not unique to energy. It's a broad-based old economy problem. And the seeds were sowed to this going all the way back to 08, 09, when we saw long cycle CapEx shunned in favor of short cycle CapEx. People wanted a quick return. And now you're paying the price for it.
Yeah, the problem market, of course, it touches, spending power. It's people actually that can't afford gas bills. It also means that people can't get into their car, for example, in London, because a lot of the petrol stations are closed. Marco, what does this mean? We're going through an energy transition, right? What does this mean at, having this kind of supply price of power crunch, when people could also blame renewables and saying, look, it's part of the problem that it just happens in terms of timeline at the same time?
Well, I think what's been exposed is the fact that if you have no wind, you can have as many wind farms as you want, but you have an issue. So I'm a believer that hydrogen can be a means of storing that wind energy when there is wind and producing more wind capacity to store in the underground storages that we have energy for times like this. And hydrogen will act as a stabilizer because you can absorb electricity when it's cheap and you can turn it back into electricity when it's expensive. So once we have a lot of hydrogen in the mix and more batteries on the roads and a more stable system that will be relying more on renewables, we will have some bands where if electricity prices drop, you simply produce more and store it. If electricity prices rise, you simply take it out of storage. So that's really what we're missing right now is storage. We have strategic petroleum reserves. We have a lot of oil storage, a lot of oil inventory, but in the UK, there's hardly any gas storage. And in Europe, the storage that we have is half empty. So that's really contributing to a specific European issue. And we're talking about this at the end of September, and we still have the winter ahead of us, which can be concerning in case it's cold.
Yeah, and it looks like it could be a cold winter. Jeff, so why have we not invested more in renewables? And again, we're trying to figure out exactly this relationship between renewables and what's going on right
actually,
now.
the one sector that we did invest in over the course of the last 5 to 10 years has been in the renewable sector. Many parts of the world, you've overbuilt wind, you've overbuilt solar, to the point that you've ran power prices negative when they try to get onto the grid, because the focus on ESG investing and being green has saw capital go that direction. It's the old economy. So the new economy is overinvested, the old economy is starved. And again, I want to emphasize gas, coal, oil, metals, mining, you pick the old economy, it is severely underinvested.
But Jeff, what you're saying, but there needs, in the transition phase, right, these needs to be together. So if we don't have enough wind and if you have intermittent power, then you need some kind of solution.
Exactly.
So that in between you can fuel it with something.
Right, but the problem is the best fuel for that is gas to deal with the intermittency problem of when the wind's not blowing and the sun's not shining. Now the problem with gas, it is a old economy hydrocarbon-based fuel. It requires investment in E&P companies and the broader old economy, which is, by the way, people want to say this is ESG. I want to emphasize it's bad returns. These companies have not demonstrated good returns for 5+ years. And even if you go back into 10 years, it's been relatively poor. Now you look at the returns of a Netflix, they're far greater. It's no wonder the capital was redirected. So the only way you're going to see capital go into this sector is you got to get the returns up. You need the prices of these commodities much higher to get the returns sufficiently enough to start attracting capital. Or I guess you can say the hurdle is rising and rising with the green initiative, which means you just got to have higher dirty fuel prices to get the capital to flow. But it is a question of flow of capital, not access.
So, Marco, do you agree with that? There just hasn't been enough, capital going, for example, into gas. And at this point, what can Europe? I mean, we're talking about the whole world, but is Europe at a disadvantage also because of how it's positioned?
We may be a very old economy outlier, but we've been returning capital to shareholders in over 180% over the last 5 years. And we've been increasing our investments over time. And we find because of the very low cost of debt, we do have the capital we need. I think the uncertainty around the future of gas is really what's creating a lot of resistance to invest, especially on the upstream, which is not what we do. And so a lot of projects have been put on hold. It must be said that demand has surprised the markets on the upside. I think no one really factored in how much progress China had made over the last 3 years in substituting coal for gas in people's homes. So China essentially added a market almost the size of the UK over the last 3 years. And because of the reasons Jeff has been saying, investments upstream have been lacking. And so we're in a specific crunch. I'm an optimist over the summer because no one really wants gas in the summer because we use so much of it for heating that we will likely see prices come down very quickly in the summer. About the following winter, we need to invest more in storage. We need more gas storage. We need to do for gas what we've done for oil after the Second World War. Why do countries have strategic oil reserves and they don't have strategic gas reserves, which is a lot more critical because you can reduce oil consumption, you can have different modes of mobility, you can share cars, but you can't share heating when it comes to homes. So we really need to invest in storage. The UK should invest more in storage, and Europe should fill the storages that we have. We have, for instance, in the Ukraine, a lot of storage. And if Europe does it right with the storage, because it has more ability to produce and generate storage because of the depleted fields we have in the North Sea, in continental Europe, in Holland, China doesn't have that ability. China has a lot less geological potential for storage. So if Europe invests in storage for gas, it will help stabilize the global LNG prices, taking in the cheaper summer gas and producing it in the winter, because all the gas consumption is in the northern hemisphere. And if it's cold, it tends to be cold at the same time everywhere in the northern hemisphere. We really don't have summer demand for heating. So that big seasonal swing is something that we need to address with storage, and provides not only cheaper prices, but also greater resilience.
Marco, a question to you both, and actually it's on storage. Is there going to be like a global race now for storage? And what does it mean for prices?
Well, when you think about storing natural gas, it's far more difficult than storing metals or
gold.
Oil or gold or something like that, because you actually need to have old gas well reserves, something like that to put it in. So places like Europe, the storage is very difficult. U.S. and Russia, because they have the old gas fields, have the capability to have large gas reserves. I want to point out, we call this a global energy crisis. There's one part of the world that does not have a crisis, and it's east of Rockies, United States. So from the east of California's got one, but everything east of Rockies all the way to Washington doesn't have one. So you don't hear this noise in the U.S., but it's everywhere else outside of the world. And part of the reason why is because you have massive storage caverns sitting in the east of Rockies in the U.S. So that's the one part that's been avoided. But yes, there's going to be a race, but it's not like oil or one of these other commodities where you can store it easily.
Right. So does it push actually the race towards renewables? And actually, to Marco's point, do they need to be cheaper? Like, how does this transformation take place? Can renewables in 2 years, if we invest enough in them, transplant old fuel?
Well, I think when we look at it, part of the problem that happened that created this initial spike was the wind quit blowing, and you saw a huge surge in gas demand to offset the lack of wind, and that's what created the initial spike. So the key point here is you need that intermittency fuel for when the wind's not blowing and the sun's not shining, and gas is that fuel right now. There's other sources, but I think the key point here, and I think Marco hit on it, is this started with coal going all the way back to China. And this summer, really, it was China that really kicked off these problems. And the problems that we're seeing in growth concerns around China, everything stems from the inability to be able to increase power production. They're cutting aluminum production, steel production, and so on down the line.
All right, thank you both. Jeff Curry from Goldman Sachs, Marco Alvera, Chief Executive of SNAM, both stay with us. Coming up, we continue our conversation with Jeff and Marco. We talk a lot more about the future of renewables and actually where they see the best value in the next 2 to 3 years. This is Bloomberg. Welcome back. This is a Bloomberg special, Price of Power. I'm Francine Lacqua here in London. So we have a viewer question to both Marco and Jeff. Remember, you can send them to us on IB Plus TV Go. I have to say we've been getting quite a few of them, so please continue sending them in. Now, this viewer asks, the IEA is saying that they should not invest in new oil and gas developments. How would it affect the situation we are currently witnessing? So let's get back to Jeff Curry from Goldman Sachs and Marco Alvera from SNAM. Jeff, this is maybe a question to you. I mean, how disorderly is this transition going to be given the constraints on, the old energy and even some on the renewables?
Well, I mean, obviously, it's already disorderly. We wouldn't be sitting here talking about a potential energy crisis on a global basis and the implications that it's having across the globe in terms of growth constraints. Now, in terms of the IEA saying don't invest in oil and gas, yeah, I mean, there's certain investors around the world that will be constrained by this, but I like to point out there's always some investors somewhere in the world that will put capital to work if the returns are high enough. And so the key question is, where is that hurdle rate? Obviously in oil, we're near $80 a barrel. In fact, we're over $80 a barrel this morning on a Brent basis. And if we look at the rig counts in the U.S. and other parts of the world, they're showing you, hey, $80 a barrel is simply not enough. We've been at 75, 79 already. So the question is, where is that number? Where is that hurdle rate? So it exists out there. And we're going to find out where it is over the next, let's say, 6 to 12 months. But we know where we've come so far is just not sufficient to get that capital to flow.
Marco, how do you see this developing? Again, how disorderly is the transition? There's a number of also underinvestments in some of the components that, for example, it is needed to use in hydrogen to make the price of hydrogen much, much cheaper.
I think it's going to be disorderly and boom and bust, and the investment cycles are going to be a little scattery, but it's going to get really orderly over time, because if we take into account that the cost of the latest solar auction in Saudi Arabia was $10 per megawatt hour, and in Portugal it was $13 per megawatt hour, we now have natural gas at $80 per megawatt hour. So we have this incredibly cheap and getting cheaper renewable energy that's available, and the cost of hydrogen is coming down. We are investing to make it cost competitive with a $50 oil in 5 years' time. That means about $50 per megawatt hour. And the Department of Energy says it can get to $25 a megawatt hour by the end of the decade, which is cost competitive with coal. So once we achieve these numbers, then we have this incredibly potent molecule that we can use to really move and store energy around different time zones, meaning seasons, and different geographies. Yep. So we could produce huge quantities of renewable hydrogen from the North Sea, store it in the summer, and use it back in the winter when we need, whether it's going to be heat pumps or hydrogen boilers, I don't know, but we still need this kind of bulk storage. So I think the key for the transition is really going to be centered around the storage and the transport of renewable energy.
Jeff, are you expecting this kind of disruption, to last at least until the winter, or even much longer, given the underlying kind of structural concerns you outlined?
Well, yeah, I want to emphasize this is not unique to oil and gas in the energy sector. It's going across the commodity complex. And as we've emphasized, this is just the first inning of a multi-year, potentially decade-long commodity supercycle. It's driven by, we have the war on climate change, the war on income inequality. All of these dynamics lead to a structural rise in commodity demand against these underinvestments with this whole idea of the revenge of the old economy. I like to point out in the supercycle, the 2000s, the bull market started in 2003. Yeah. The energy capex didn't begin until 2006, and the metals capex didn't begin to 2008. So we got a long ways in front of us, and this is just the beginning.
Jeff, thank you so much. We need like a 2-hour-long special with Jeff Curry of Goldman Sachs and Marco Alvera of SNAM. This is Bloomberg.